In this lesson, we're going to talk about something that probably feels like the least exciting topic in accounting, cash. Not because cash isn't exciting, but because cash is pretty easy to account for. You've either got cash or you don't. And with online banking and digital payments, it's generally easy to keep track of the flow of cash automatically. But I want to challenge that instinct right away because cash is actually one of the most strategically important numbers on any company's balance sheet. And the way GAAP defines it might surprise you. Let's start with a simple question. Why does it matter how a company defines and presents cash? Think about what investors and creditors do every time they look at a balance sheet. They want to know, can this company pay its bills? Can it survive a bad quarter? Can it take advantage of an opportunity that requires quick access to cash? Cash and cash equivalents is the first number they look at because it answers those questions immediately. You've already seen the statement of cash flows, and that statement explains where cash came from and where it went. But the balance sheet tells us where it ended up. Those two pieces of information together tell a really compelling story about a company's financial health. So even though cash seems simple, it's money in a bank account, right? The accounting for it is a little bit more nuanced than it appears. GAAP defines cash as coin, currency, available bank balances, and anything that a bank will immediately accept as a deposit, like a money order or a customer's check. Cash equivalents are a little more interesting. These are short-term, highly liquid investments that can be quickly converted into a known amount of cash with minimal risk of loss in value. The key rule: to qualify as a cash equivalent, the investment must have an original maturity of 3 months or less. So a 60-day treasury bill, cash equivalent. A money market fund, cash equivalent. A 6-month certificate of deposit, not a cash equivalent. It's a short-term investment and can be converted to cash and withdrawn from the bank pretty easily, but not soon enough to be considered a cash equivalent under GAAP. The reason for the 3-month cutoff is interest rate risk. A 90-day instrument barely changes in value if interest rates move. So there's minimal risk that the company would lose money trying to convert it. Something with a longer maturity is more exposed to price fluctuation. And on the financial statements, cash and cash equivalents are almost always combined into a single line. That's why you usually see one number at the top of the balance sheet's current assets section. Before we talk about how cash is presented on the balance sheet, I want to spend a few minutes on internal controls, because the whole reason cash accounting gets careful attention is that cash is extremely vulnerable to fraud and theft. If you've ever worked in retail, you've already experienced internal controls, whether you know it or not. Let me give you a few examples. The first principle is separation of duties. The person who handles the cash physically should not be the same person who records it in the accounting system. If I'm the cashier taking in cash and I'm also posting the entries to the books, I have an obvious opportunity to pocket some cash and cover my tracks by not recording the receipt. Separating those functions removes that opportunity. The second principle is independent verification. Someone should periodically check that the cash in the bank actually matches what's in the accounting records. And that's exactly what a bank reconciliation does. We'll prepare a bank reconciliation, so I won't walk through the full mechanics right now, but the key idea is this. The company's records and the bank records both show the cash balance, but they often don't agree initially, for legitimate reasons like outstanding checks or deposits in transit. The reconciliation process identifies and explains those differences. If it can't be explained, that's a red flag. Let's talk about how cash is presented on the balance sheet, because it's not always as simple as one number. In most cases, yes, you should have a single line that says cash and cash equivalents. It's the most liquid item, meaning it can be converted to cash quickly, so it goes first under current assets. But there are situations where some of a company's cash is not freely available to use. We call this restricted cash. Restricted cash is cash that is legally or contractually limited for a specific purpose. A few common examples are bond sinking funds, where a company must set aside cash specifically to repay a debt, escrow accounts in real estate transactions, or legal settlements where cash is involved until a case is resolved. Importantly, restricted cash is presented separately from unrestricted cash on the balance sheet, and the classification current versus non-current depends on when the restriction expires. If the restriction lifts within a year, it's current. If it extends beyond a year, it's non-current. Why does this matter? Because if you see a company with $50 million of cash, but $45 million of it is restricted, the liquidity picture is very different from what the headline number suggests. Two more balance sheet issues worth mentioning briefly. First, compensating balances. When a company borrows money from a bank, the bank sometimes requires the company to keep a minimum balance in its account. You might have experienced something similar with your own first credit card. The bank requires you to maintain a deposit as collateral sometimes. That minimum balance is considered a compensating balance. If the compensating balance is legally restricted, meaning the company can't touch it under the loan agreement, it gets disclosed separately in the notes. If it's just an informal agreement, it's still cash, but the company has to disclose the arrangement. Second, bank overdrafts. When a company overdrafts its account and the bank covers it, that creates a liability. Normally, we would think of it as current, almost like accounts payable, to the bank. But here's an interesting case. If the company has another account at the same bank with a positive balance, it can offset the overdraft against that balance, presenting only the net amount on the balance sheet. It does not reclassify the overdraft to accounts payable. Let's bring this home from an analyst's perspective. When you look at a company's current ratio, which is current assets divided by current liabilities, cash and cash equivalents make up a meaningful portion of the numerator. A company with a high current ratio looks liquid, but if a lot of cash is actually restricted cash, the picture changes completely. This is exactly why good financial analysis requires you to read the footnotes of the financial statements, not just the face. The balance sheet gives you all the numbers, but the footnotes tell you what those numbers actually mean. I'll show you a real example in our class exercises, but for now the key takeaway is this: cash is the most fundamental measure of a company's ability to function. So GAAP is very precise about what qualifies and requires transparent disclosure when cash isn't freely accessible. To summarize, cash equivalents must have an original maturity of 3 months or less. That's the line between a cash equivalent and a short-term investment. Restricted cash is presented separately and classified based on the duration of the restriction, not the type of the asset. Internal controls protect cash from fraud, and bank reconciliations are one of the most important tools for verifying what's on the books and what that says matches what the bank says. And as a financial analyst, always check the footnotes when evaluating liquidity. The face of the balance sheet doesn't always tell the full story. In the next lecture, we're going to move from cash to accounts receivable, and you'll see that a lot of the concepts from our previous lecture on revenue recognition carries right over into how we measure and report what customers owe us.